equity compensation continues to be an important tool, and this is also evidence in our survey this year. It is used for attracting, retaining, managing right talent, and also enabling alignment between the shareholders and employees, sharing the business valuations, value as the business grows, and that success carrying forward. So what we have done this year is we expanded the area. So we went to Southeast Asia also, where we asked the companies to participate, and we got more than 300 companies to participate in this year's surveys. This took us around 3 months, and we finished it around December, and after that we took time to analyze that data, and today we are launching the survey. The questions that we asked was in excess of 30. We tried to get insights on the plan framework, also around what are the challenges they are facing, administration issues, questions relating to accounting, taxation. So this is pretty much quite comprehensive. In the design part of it, it includes questions around what is the ESOP pool, how many employees were covered, what are the levels these programs have been rolled out to, what are the instruments that have been used, what are the routes through which companies have implemented their program, whether these are trust or direct, what is the quantum at the individual level, are there ways of measuring these quantums when these are granted. So it's quite comprehensive in that nature. This survey expects to provide companies insight into how they can maximize the potential of their ESOP program. At the same time, also to if they are planning to implement a new program, or if they are planning the first time implementation, this survey will be quite useful. So coming to the participation side, as I was saying, we had more than 300 companies participating. Of that, around 90 companies are listed, and around 200 plus companies are unlisted. So it has a composition of both practices from large scale companies to companies which are at early stage, unlisted companies, both funded as well as unfunded. From a respondent side of it, the good thing is that these responses are coming from the senior most level. So around 70% of the respondents are from, mostly they are CEOs and CXOs and VPs. So we can, the quality of this survey, from that count always increases because of the levels from which the responses have come. Around 54% of the companies have more than 200 employees. So this also suggests that, from a stability of the organization point of view, the practices are, we can say that they are followed and practiced well, and not just evolving, which may be a case in a startup companies. So well represented in terms of the composition of companies, also the number of employees these companies represent. One clarification which I want to give here is that we have not gone to the employees and asking them questions about what they feel about their program and what is their feedback. So this survey, it's only capturing the voice from the management side of it. This is not capturing the voice from the employee side of it. Okay. This is the question which is primarily asked is what are the objectives of implementing ESOP. So both listed companies as well as unlisted companies, their main objectives continues to be retention and reward. So if we see in case of listed companies, 71% is voted for retention, 59% have said that reward is their main objective. So this question was framed in a way where they can give response to multiple choice. So these may be common in some cases. This also may be, in some cases, they would have said only retention and reward, while in other cases they may say that these four may be my main objectives. So retention reward continues to be the main objectives. Achieving performance target, if you see in both the listed and unlisted companies, this is also a significant number. So whether the companies still continue to have this retention reward, or they are moving towards stock options being part of incentives which is used for driving performance, is still to be seen. We will relate it with one more data point in the next slide. The good thing is on the achievement side of it, that these are the objectives, how these were reflected in terms of the achievement. So around 90 to 97% of the companies have said that these objectives were either fully or partly achieved. Yeah. So on the coverage side of it, we are seeing in listed companies, the coverage is still up to 10%. So in listed companies, broad-based program, or including maybe junior levels of management, is not something that is getting evidence. 81% of the companies said that they are giving it to senior and middle management. Along with that, the selection criteria continue to be past performance, what is their current designation, and also their potential to climb the ladder fast in future. So the questions that we have asked here was coverage level and the criteria for eligibility for participating in the program. So this is what we have got. From a listed company standpoint, it is also quite clear that they will have hierarchies. So from a level standpoint, 10% of it would be covering senior and middle. So that sort of correlates the two responses together. The selection criteria, past performance, current designation, future potential, is something it's been evidenced in previous surveys. So we have not seen any other change in the criteria over there. Even in case of unlisted companies, if you see, the selection criteria are same. However, in case of unlisted companies, there are changes pertaining to the strength in terms of how many people are getting covered over there, and also the levels. So there in unlisted companies, when we went down and further analyzed it to relating it to the stage of funding, we found that seed and pre-seed companies were granting to around 40% of their employee strength, whereas Series A companies were granting up to 20%. So there is a downward trend, which means that as the companies is scaling up and your employee strengths are growing, your concentration of the grants is getting focused to a particular level. So this needs to be seen in next 2-3 years, whether this change is getting we are getting more broad-based sort of a program. But today we don't have a broad base which is commonly observed. One more implication here could be that whether the companies realize that broad-based program can help achieve better performance, whether this can motivate everyone in the company, is something that we have not evidenced in the survey. So broad-based programs is something which we have not found. This is again the important question to ask, is what is the frequency of the grants, and what is that benefit which is sort of estimated as a target opportunity, which the stock options should finally convert into money at the end or during this program. So their annual grant is seen to be more popular. So this is one change that we are observing. Earlier, annual grants was not something which was commonly seen, but now annual grants is picking up. In case of listed company, this can also be one of the reasons, because underwater option situations will not be there in an annual grant because it works like an SIP. Whereas in a one-time grant, what happens is, suppose the prices were to go down, the options will remain underwater. So annual grant in listed companies is getting more popular. On the quantum side of it, the target opportunity is around 80 to 100% of the CTCs per annum. So what it means is, suppose this is the higher end of the spectrum. So 100% of the CTC per annum means that if I am giving a stock option today, 100% CTC per annum, and suppose this is a 4-year plan term sort of, so it is like 4 times of the CTC which the employee should expect it to get from his stock options plan. So this is something 80 to 100% is what we have learned from the company's responses. Most companies, enlisted companies, are granting to CEOs and CXOs. The portion of the grants, around 50% of it is going to CEOs and CXOs. The unlisted companies, there also there are grants which are given at the time of joining, but annual grants there is also very popular. From a quantum standpoint, this continues to be 100% of the CTC per annum, which is in line with the previous service which we have done in earlier years. How to define the value per option? So on one side, while the companies have calculated the target opportunity, which is basis the benefit mapped to the CTC, now the point is, how do you define the value per option so that this can translate into quantum? So by dividing the target opportunity by value per option, I should know what is going to be the quantum has to be issued to the respective employees. So here the practice for listed companies is they are using fair value. So basically they do the Black-Scholes calculation and they divide the target opportunity by the Black-Scholes, and that is how they are arriving at the quantum of options. There are also companies who are using future appreciation. So basically what it means is, what is going to be my appreciation? So applying maybe some estimate on the CAGR, or using some peer multiple, or some estimates over there, so that you know what is going to be the benefit in that option. So suppose my price today is 100 and I expect my share price to go to 400 in, let's say, in next 4 years. So that 300 becomes my benefit, my appreciation. So my benefit per option becomes 300, and I divide my target opportunity by 300 to arrive at the quantum. Some companies are using market price also. So what they are doing is they are dividing the target opportunity by the market price, which we feel is not right. There is a fallacy in it. In case of unlisted companies are also using fair value, but market price at the time of grant is something which is very close to the response which we have got from the fair value. Now the fallacy is, suppose I just divide it by market price, which is today's price, then I am not taking into account the future appreciation, right? Which means that I would be granting more. My dilution will be higher in case of if I am using market price as a denominator. So this is a fallacy which needs a correction. We are seeing companies using this method, but we feel that it should get corrected in as they realize it. We asked the question about what are the types of instruments which have been implemented. So whether this is one instrument or a bouquet of instrument, what is the mix of instruments there? So, and also what is the route companies are using, whether this is direct route or trust route. So for listed companies, we are seeing RSUs and ESOPs as a mix now emerging as in all probability something which most of these companies would practice. Earlier, the trend was towards single instrument, but that is changing, where the companies are open to experiment, look at other also options doing the feasibility assessments. But apart from ESOPs and RSUs, there are SARs and Phantom as well. But we have not seen SARs and Phantom yet becoming drivers in the mix. But as far as the adaptability towards multiple instruments in the ESOP mix, that is something which we can say in listed companies, it is happening. From our implementation side of it, implementation through the trust route is also increasing. So why this is increasing? There can be reasons for it. One, secondary market purchase. So to avoid dilution, companies are purchasing shares from the market and using those shares to fund their ESOP pool instead of doing primary allotment. So again, this is a trend that we have evidence. This is a major trend this year. The trust route has increased from 20 to 43%, which is almost like doubling, and whereas the direct route has come down from 80% to 57%. So the clear indication is companies are using trust route, and they are using the advantage of having a trust route in their program. In case of unlisted companies, the primary instrument continues to be ESOP. Now, here the definition of ESOP, whether this is given at market price or this is discounted to market price or face value, this is more or less an interchanging nomenclature. So some may call it ESOPs, some may call it discounted ESOPs as RSUs, or maybe some other name. So as far as unlisted companies are considered, what we have observed is till the time there is price discovery which happens, companies tends to grant options at face value or at a discount to market price, because price discovery has not happened. What we have not seen yet is companies pegging their exercise price to the price discovery price, which happens at the stage when institutional funding happens. So for unlisted companies, discounted ESOPs or face value is something what we have observed. Unlisted companies are not popularly using the trust route because of the cost and the process which gets involved in trust administration. Now, this is from the ESOP pool and the source of equity. So for listed entities, we are seeing the pool size of around 0 to 5%, and the market purchase, as we have also seen in the previous slide, the market purchase of shares have increased. So this data is correlating with that data point that the increase in trust route with listed companies is actually also showing that there is an increase in the market purchase of shares. In case of unlisted companies, ESOP pool has increased from 5% to 6 to 10% of the total equity. Now this is an average number. We also have a analysis done. I was doing that analysis in terms of stage wise funding. What is that pool? I'll show it in the next slide. So unlisted companies around 10%, whereas listed companies around 5%. From a promoter's contribution to the pool, I mean, in listed companies, we are seeing this year there has been a change, and this is significant because from 15% to 40% this has increased. What it means is the promoters or the existing investors or the shareholders there, they are contributing towards the ESOP pool. So what it could mean is the investors who are coming next, this may be institutional investor, they are not diluting. It is actually coming from the promoters pool when they are funding their ESOPs. So let us also look at the stage-wise number. So we have on your right-hand side, pre-seed, seed, Series A, pre-IPO. These are the funded company, and on the left-hand side, this is the unfunded companies. So in unfunded companies, we are seeing around 14% pool size, whereas in case of pre-seed to seed Series A companies, we are seeing a number which is closer to 10%. So this is also relating to the average numbers that we are seeing, +5, -5 can be an optimization. I'll come to the exercise price. So exercise price is also, I mean, it can be related with the type of instruments the companies are using. Now, if this is RSUs, the exercise price is going to be a face value. So face value and discounted ESOPs or discounted to market price, we are seeing increasing in this period, last 2 years. There could be, 2-3 valid reasons for it. One, because of the pandemic, there were, salary, cuts, which companies tried to, compensate through ESOPs, discounted ESOPs or RSUs. So that we are seeing. Second is to contain the dilution. So basically, the more we discount the exercise price, the lesser are the number of equity that is required, or we can run that existing ESOP pool for more number of years. So that we are seeing happening during the last 2 years. Companies are, giving ESOPs. They are also doing RSUs. They are managing liquidity. So there's a, there's a replacement from a variable to RSUs. That's also happening. We are seeing, and from a peer pressures as well. If someone else is doing an RSU to make your program more attractive, you tend to also, discount your, stock options. So recently we have seen HSBC, actually HDFC Bank and ICICI Bank, they came with their first RSU program. And this has been followed by Axis Bank, and there are other banks also who are going to, implement RSU sooner or the later. So this is again a major, trend. Actually, IT and banking practices are followed by other sectors. So we are seeing RSUs, getting more popular in the larger context. In case of unlisted companies, face value grant has been increasing. So the RSUs there are, quite popular. Almost 50% of the companies are granting, face value stock till they reach the Series A. So when we analyze the trend with respect to vesting and exercise period, in case of listed companies, 3 years is a normal vesting period, whereas from a exercise period standpoint, it remains around 2 to 4 years. Now the trend has been more or less stable, so there's not been much change in this for listed companies. Actually, the exercise period has come down. Earlier, it used to be in many cases like 7 years, 8 years, or even 10 years. But because of the application of accounting standard, the companies are also conservative when it comes to the exercise period, because the more your exercise period, the more will be the expected life of the option, which means the higher accounting cost. So now this is getting optimized. My assessment is that going forward, this 2 to 4 years exercise period will further come down. 3 years vesting period is something which we are seeing for many years, and we expect that this trend will continue. There's also a trend which we have noticed is reduction in the annual vesting cycle. So typically annual vesting is like very common in the stock option program in India. Quarterly vesting schedules is not something that we have seen, in the many companies, but last 2 years, half yearly and quarterly, vesting schedules is also something which the companies have set in the listed companies side. The mix of time and performance-based vesting is what most of the responses came. So there's a gradual shift from just a time-based vesting to mix of time and the performance. What is the weightage? How much is for time? How much is for performance? That can be a detailing when we study those sectors specifically. We can also find out that. Actually, we have asked that question. In case of unlisted company, vesting period continues to be around 4 years. This is the preference with unlisted companies. Unlisted companies still use 73% of it. Actually, a very high number is still using annual vesting. But we are seeing this trend from half yearly and quarterly vesting schedule, which is increasing. There also, it's a combination of time and performance vesting. Wherever there are RSU grants, unless it is a joining grant, these grants are mostly with performance conditions. So that is the most of the observations from the unlisted company side. The unlisted company, one thing which we have seen this year is typically the unlisted company exercise was linked to a liquidity event. And this is what, I'll just take you from Vikram's point of view, that private market is evolving and these concepts are getting spread out. So this is one change which is getting reflected here in the survey, that the schemes are now, modified in a way where the employees can exercise their options prior to a liquidity event, because now the funding sources are available. So this is something which we are seeing as a trend. This will continue to evolve. So the trends with unlisted company scheme rigid in their nature, where employees can exercise only when there was a liquidity event, I think that is going to change quickly in next 1 or 2 years. We will see more and more companies allowing exercise, happening, and they may be even open for employees selling their shares outside. So once we have this macro structure established for unlisted companies, private markets, I think ESOP's strategy here is also going to change. So this is from the vesting and exercise period in unlisted companies. Now coming to my last slide here, and I'm just summarizing what I have said so far in terms of my assessment to this year's survey. I'll just recap those points. So retention and reward are the main objectives. It continues to be same for both listed and unlisted companies. I think performance-based incentives will rise, and it may replace one of these two objectives in next 2-3 years. That is what my assessment is, because more the RSUs are being granted, the performance orientation will become part of it, and the companies in their overall program will look for those type of incentives where these have company performance or individual performance or something which relates to the performance for overall business and the employees. In terms of the coverage, unlisted companies are expanding deeper within the organization. So this is whether they continue with this trend as they become large organization. This is something which we have to see, because it is easy for you to grant and cover more employees when you are at an early stage, but whether you continue that trend is something, it may be difficult unless until you increase your pool, that will be a challenge. RSUs are increasing in the trend, both with the listed and unlisted companies. Sourcing of equity through secondary market purchase in case of listed companies, this is where we are seeing an increase. Trust route is getting more popular. Whether this translates into a practice with unlisted companies, that we need to see. Allowing employees in unlisted companies to exercise prior to liquidity events. So this, with the advent of private market, getting that structure established, I think this is also going to increase further. And along with that, the liquidity event, which through buyback by trust or by the company or by the investors, that is also something which we have seen. Though this has dried up in the last 6 to 9 months, not as frequent what we have seen in 2021 because of the lack of funding. This was initially done by the investors, the existing investors of the company. But as this realization comes in, that it cannot be just one time liquidity event that the company should do, and then they wait for 12 months, 15 months or longer, because there are players available who can fund the purchase of ESOPs. They can provide liquidity, and this is where this solution is going to help. So liquidity event will rise in future. That is what my estimate is. So with this, I'll conclude my presentation.